What if I told you that learning to trade ICT is actually a lot easier than you think? Now, I've been trading for almost 9 years, and I'm able to get winning days like this, and this consistently. But it took me years to be able to make consistent money as a trader. But if you follow the strategy that I'm going to teach you today, you'll be able to make more progress as a trader in the next 3 months than most traders make in the next 3 years. Most traders think that ICT or getting good at ICT requires mastering all these different complicated concepts. And I understand it because I made this exact mistake and I wasted years of my life trying to learn every last one of the things that ICT taught. My charts literally look like a laser show marking all these different levels. I was trying to use everything under the sun to try to determine where price was going to go. And what this caused me to do is I would look at super old levels from old legs and price action. I was trying to map out premium and discount, trying to determine the daily bias. And every time I tried to take a trade, it was like there was 10 things on either side of the market, either telling me to go long or telling me to go short. And I would just get paralyzed and either hesitate or make mistakes. And I sat on this hamster wheel for a very long time. But then I removed all of the fluff. And I'm not kidding when I say I instantly became profitable whenever I removed all but 2 specific concepts. And after wasting years, and I mean literal years and hundreds of hours of my life, I realized that ICT, when done correctly, wasn't even that hard. I had just been misguided, thinking that if I didn't master all these different big word concepts, all these complicated things, that I would never be a profitable trader. So today you're going to learn those exact 2 concepts plus a way to put them together every day to find profitable trades. And my goal here is to save you guys the years of confusion that I had to go through and get you profitable much faster. But first, let me show you why most people say that ICT is hard. You see, the problem with most traders is they try to master dozens of these different ICT concepts at once. And it doesn't help when you have ICT himself or numerous other gurus always releasing some new shiny object. And what this does, for a lot of traders, they think that learning more advanced things is going to make them a better trader. But in reality, what it actually does is it creates analysis paralysis, which means you have too many things to consider and you never can pull the trigger, or even if you do pull the trigger, you don't do it with confidence and you end up making all the mistakes that make you unprofitable. Because when it comes down to it, profitable traders in ICT really just use 2 concepts consistently, not 47 occasionally. Now, myself and tons of other ICT traders that have made 6, 7-figure payouts, I've talked to them all and they all use these 2 concepts and literally nothing else. So instead of focusing on these concepts, some of which have ridiculous names, I kid you not, ICT has something called consequent encroachment. I mean, they've even complicated fair value gaps. And instead of just focusing on this, which is where most ICT traders put all their attention, this is just the surface. And the 2 concepts that actually matter are the ones that are going to make you profitable. Now, you need to make a deal with me, and not only me, but with yourself. And that's that if I can show you that all of these different concepts besides these 2 don't matter, then are you the type of person who will actually be able to be consistent with this? Because what I see among a lot of traders is they get information that could change their life and they end up skipping away from it and just focusing on the new shiny object. But if you can avoid this, if you can stay consistent with it, if you are the type of person who can actually do this, then you're going to become profitable nearly immediately. Now, the first of these 2 concepts, which you've probably heard about, is liquidity. However, most people get this completely wrong. Now, all liquidity is where stop losses are sitting, and there are 2 ways to properly spot liquidity on your chart. Now, what most people will tell you is just to look above swing highs or lows. Now, this does work. I recommend that you use the 15-minute chart or higher to do this. And you can mark out and see that, okay, well, sometimes we hit liquidity and we reverse. And then you'll see sometimes we hit liquidity like this over here and we don't. And it takes a while to actually reverse. So how do we know which liquidity is likely to give a reversal and then which liquidity is likely to get ran through? Now, before we go into the second way to spot liquidity, you need to understand that there are liquidity runs where price is likely to continue through liquidity, and there are liquidity sweeps where price is likely to hit into a swing point and then reverse. Now, the way that you're going to determine whether or not price is likely to run or likely to sweep is very, very simple. You see, what we need to focus on here is a term that I call displacement. Okay, guys? If you guys have been following me for any amount of time, you've probably heard me talk about displacement. But for those of you who don't know what displacement is, all it is the way that we react with a swing point once we trade into it. So notice right here, we hit this swing point. And the market does not really push through it. Now, you might be saying, oh, well, it closed through it. Look, I am not just looking for a close. I want to have an energetic push through the level, and I also want to see the second concept of the two concepts, which is a fair value gap. Now, for those of you who don't know already, a fair value gap is simply when we have a very expansive candle that results in leaving a gap between the candle before its wick and the candle after its wick. So this is a bullish fair value gap. Now, for an example of a bearish one, notice this candle right here was expansive and left a gap between this candle and this candle's wicks. Now, there are specific ways that we're going to use fair value gaps so you know which ones are likely to give a good trade and which aren't. But to understand what a fair value gap is, it's rather simple. So notice how with this swing point right here, we created a fair value gap going right through it. And also notice how the market continued after it. Now, you might be wondering right here, well, we created a fair value gap into the level. And I want to be very clear, you need to create the fair value gap through the level to get a displacement. So anytime that you fail to create a fair value gap through a swing point, you can expect a reversal. Now, you can quickly see that this opens up a world of opportunity for you to find trades, because if you can identify that the market is hitting into a liquidity point and it's going to fail and it's likely to reverse, well, then all you have to do is go into the lower time frames and use a entry strategy to find profitable trades. Now, I'm going to give you the full application and the full strategy here in a minute, but I want to give you an even more high probability way of finding liquidity pools. But just to recap and keep things simple, every time you hit a swing point, if you create a fair value gap through it, then you expect the market to continue. If you hit a swing point and you don't create a fair value gap through the actual point of structure, then you expect the market to reverse. And you can go test this on your charts. It works so consistently. Okay, guys? Not going to say it's 100% because nothing is. And you can pair this with the second type of liquidity that I'm about to teach you to get even higher probability, but understanding this alone can help you become a more profitable trader. So we've established that you can look above swing highs or lows on your higher time frames to find pools of liquidity, but there is a much more powerful way to spot which liquidity to focus on, because as you can see, there's a lot of swing points. And to be a good trader, one of the things that you have to do is learn how to eliminate complication, which is the whole point of this video. And the way that we're going to do this is by using time-based levels. There are two levels that we're going to be focusing on, which are the previous day and previous session liquidity. So what you're going to do is you're going to get this vertical line tool right here, and you are going to mark out a line right at midnight. You're then going to take that same vertical line tool, and you're also going to mark out a line at 6 p.m. the previous night. You're going to take that tool again, and you're going to mark out 6 a.m. So what you just did here was you marked out the Asia session, which is over here on the left, and then over on the right, you're marking out the London session. Now, the London session and the Asian session are prerequisites to whenever you're trading New York, and you need to understand the story that's being told in these time frames, in these windows of time, in order to have the highest probability of liquidity. So what we're going to do is we're going to mark out the lows and we're going to mark out the highs of each session. So we've marked out the high of the London range. We've marked out the high of the Asia range and the low. Now, if you notice right here, the low of the London range was already hit pre-market, and we've already moved far away from that, so you wouldn't be paying attention to it. But one little thing you can look at is notice this. We created this fair value gap through it, and therefore the market was likely to continue. So let's just say you were trading pre-market. You could have looked for a trade out of this fair value gap to the next time-based level. Now, whenever you have a mechanical way of marking out levels like this, trading becomes a lot more simple. And notice how we're only focusing on certain points of liquidity rather than trying to trade every single one. This will remove the need to trade and help you guys stop overtrading and losing money. Also, it makes ICT a lot easier because whenever you know exactly which levels you're going to be trading from, most of the heavy lifting is done for you and you don't have to stress or overthink. Now imagine if you knew exactly where to trade from. What would your trading look like? Would you be a more profitable trader if you could sit and wait patiently for the highest quality trades? Now, for the previous day liquidity, what we would do is you would go to the previous day and you'd mark out 6 p.m. for futures because this is where the daily candle was created. You could also just go to the daily chart and mark out the high and low like that of the previous day. Now that you understand the basics of liquidity and fair value gaps, you need a simple, and I want to put emphasis on simple way to put it all together into finding profitable trades consistently. So I'm going to give you 2 core strategies that are going to give setups every single day that are going to help you become a profitable trader. And both of these gave winning setups in different directions on the day you see right here. All right, guys, so let's break this down with some live examples. So earlier we talked about marking out our time-based levels, and we're going to use these in the first strategy I'm going to teach you. So as you can see here, we have our previous day low, Asia high and low, and then London high and low. So once you've got all these marked out, what you want to do is wait for 9:30 a.m. if you're trading futures like we are in this example. And what you want to wait for is one of these levels to be hit. Now, notice right here we hit into the London low pre-market and we created that fair value gap on the 15-minute through it. And it also created fair value gaps on multiple time frames. So when we come back to this level during the session, okay, not before the session, right here was before 9:30, but when we come back to this level during the session, since we're expecting the market to continue to the downside, because remember, we hit into this level and the market then created a fair value gap through it right there. So when that happens, we're looking at this as a flipped level. And if the market comes back up to this level, we're going to then look to get a trade down towards this Asia low. So we're going to take a look at this trade and show you exactly how you could have caught it. Now we're going to go down to the 1-minute chart for this. And once you hit into this level and go into the fair value gap, as you see here, you're going to wait for one of 2 confirmations. Now, the first of which is going to be an inverted fair value gap. And the second is going to be a change in state of delivery. And I'm going to show you exactly what both of these look like. So an inverted fair value gap is pretty simple, right? Like if we hit into this level right here, what you want to see is after we trade into this level, do we invert any fair value gaps? Because if the market starts disrespecting these fair value gaps, well, you can expect the market to move to the downside. Now, the second thing we want to see is called a change in the state of delivery. So what you'll see in this example is we didn't get any inverted fair value gaps. In fact, you can see that we traded into it right here and we didn't close a body through it. So what you would have wanted to see for an inverted fair value gap is the market to close its body below the fair value gap. You didn't see that. But what you did see was a change in the state of delivery. So a change in the state of delivery is very simple. A lot of people get this wrong, but a very easy way to simplify it is just look at it like who is in control, right? Our up close candles engulfing down close candles. You see right here, we had a down close candle, then an up close candle engulfed it, down close candle, up close candles engulfed it, down close candle, up close candles engulfed it, until we get this change in the state of price delivery. So now sellers are in control. And if we see sellers getting in control at one of our key levels, or 2 key levels in this example, which are our time-based levels and our FVG, well, at that time, you know that this is the first sign of a reversal. So you can then enter a trade with confidence that it's a very high probability the market's going to move from this level down to the next, because all the market's doing is moving from one key level to the next. So whenever you simplify your trading and you only map out time-based levels, it becomes rather easy to find your take profits, to find your entries, your stop losses, and everything in between. So you would have this Asia low right here, and that would be your target. So you'd enter the trade as soon as you got a candle close that engulfed this up close candle. So right here, you would enter a trade, and you would put your stop loss right there and target this low down here. Now you can see that this is very high risk to reward. This is 13 to 1. I'm not going to sit here and tell you you're going to get this every single day, but just trading one contract on NASDAQ and putting your stop right here above the high, because once you get this change in the state of delivery, you'd want to put your stop right at the highest point that was made. So you'd put it one tick above. You'd be risking about $220. So you could take this on any prop firm or any personal account, really. But if the trade wins, you would make $3,160. As we can see, the market takes a second, but it starts moving really aggressively in our direction. So this trade, you would have been able to make $3,100 while risking $200 using a very simple strategy. You're just waiting for a key level to be hit and then one of these 2 things to happen on your lower time frame. So let's take a look at another example. So right here, we've marked out the Asia low and high and the previous day's high and low. I'm going to show you how you can catch setups even in London session. This strategy works no matter what session it is, because at the end of the day, the markets move from one point of liquidity to the other. So whenever you're waiting for a trade, if you're trading this time-based strategy, all you're going to do is you're going to wait for one of these levels to be hit. And as you can see here, the Asia low was hit. So if we look right here, what happens after the market is hit? This is going to tell you literally everything that you need to know. Because whenever you're at a high area of liquidity, like one of these time-based levels, all you need in order to get active in the market is to see a response from it. Now, in this example, I'm going to be showing you guys a reversal. Now, in the last example, I showed you guys how you can use old time-based levels and then just use them as support or resistance. But if you look at this level right here, we didn't really push through it. Like, we didn't create a fair value gap through it. So with that being said, we have a lack of displacement, and you would expect the market to rebound. Now, where is the market likely to go to? Well, we've got this Asia high up here. So you see that once you understand, the market's either going to reverse or it's going to continue through one of these key levels. There's an opportunity on either side. And on this day, which is literally today, right? I'm recording this June 5th. But when you look at this setup here, all you need to understand is whenever we hit into the level, what happens after it? In this example right here, you'll notice the market heavily pushes up. We get that change in the state of delivery right here. So as soon as this candle closed right there, you would have then got into a long entry and you would put your stop loss. You could just put it down here at the low. If you want to be aggressive, you can put it down at candle bodies. For beginners, I recommend just putting it at the low and make sure you have a good risk to reward. As you can see here, this is 2.5 to 1. So you would buy right there because the market is telling us we're moving away from one key level and then likely moving towards another. So at that time, you would just sit back and let the market do the lifting for you. And as you can see, the market hit into the level pretty quickly. There is also another opportunity that occurs once we hit this Asia high. And for a lot of you guys, this is going to be a game changer because you may have missed the first trade of the day. And I always see traders, they think if they miss the best perfect entry, that the day is just over. And oftentimes, as long as you're staying within a very high probability strategy, there's going to be more trades. So notice right here, we hit into the Asia high. And just like when we hit into this level, you want to watch the reaction. So as we hit into this level, what you want to see is either a change in the state of delivery, if we're going to get a reversal, right? Like the same thing we just used to enter the market. You would want to see the market move down and engulf candles or push through some structure or invert a fair value gap or anything. But instead, you see the market do quite the opposite. You see the market continue through this level and tell us the market's going to go higher. So if the market hits into a key level and then you get continued bullish price delivery, if you're hitting, upwards into a key level, then you can execute a trade. Now, this makes ICT much simpler than trying to use a bunch of different daily bias and trying to, predict which way the market's going to go on the grand scheme, because most of you guys are trading prop firms. You don't have to do that. So at this time, where are you going to take the trade? Well, if the market hits into a level, doesn't give you any kind of reversal, and instead gives you confirmation we're going to continue through a change in the state of delivery or an inverse fair value gap, then you're going to trade to the next level because the market's literally telling you that it's not ready to reverse from this level. It hits the level, and this is an area where if the market is bearish, we should reverse because there's a lot of liquidity, but the market doesn't. So what is that telling you? Well, the market's still bullish. So at that time, you would buy, put your stop loss under a recent wick or a recent low, and you would just target the next level. Because remember, the market is always moving from one level to the other. And as you can see, the market moved right to the next level. And this entry is what you would call a flip because we hit into a level where you would expect the market to reverse. We got no reversal. So that tells you this level isn't going to provide a reaction and we're going to move to the next level. Now, for an even simpler strategy, what I want to teach you guys is something called the first candle rule. Now, the first candle rule is really simple. It's just that the first 30-minute candle tells you everything you need to find profitable trades. So what you want to do is map out the first 30 minutes of whatever you're trading. Now, the first candle or the first 30 minutes we're using is going to be the 9:30 a.m. candle. And you can go to the 30-minute time frame, and it's whatever candle starts at 9:30 and ends at 10 a.m. So what you're going to do is you're going to mark out the high and low of this candle. Now, the reason you do this is because the first 30 minutes of the day, this is where the most amount of volume occurs. So if we know that the most amount of volume occurred in this candle, that means that there is a ton of liquidity above the high and below the low, because above the high, anyone who wanted to short, well, they're going to be underwater or in the red. And anybody who wanted to buy, well, if the market goes under this level, then they are going to be in the red. And what's going to happen is they're likely going to sell, which means there's liquidity down below and there's liquidity up above. Now, the largest market participants need liquidity to get active in the market. And you have to think like this if you want to stay consistent, because what's going to happen inside this range a lot of times is just going to be chop. Now, once we hit into one of these levels, now you have high probability conditions. But until then, you have this consolidation where you're going to get chopped up and lose a bunch of trades. So I want you to imagine if you knew when the market was likely to consolidate versus when the market was likely to expand, would you be a more profitable trader? For most of you, the answer is yes, because the reason you're not profitable isn't because you never get good trades, it's because you don't know how to avoid the bad trades, but this is going to solve that for good. So what you're going to do is wait for one level to get hit, and then you're going to look for a displacement back into the range. And how do we find displacement? Well, the answer is very simple. And for that, we're going to go to the 5-minute chart. So for the first candle rule, you use the 30-minute and the 5-minute chart. This is very important, guys. The last strategy used the 1 minute. Very important to use the 5-minute for this strategy. So, as you can see right here, the market hits into the high. Do we get a displacement back into the range? The answer at this point is no. So you would just be sitting and waiting. But as you can see here, the market finally gave a displacement back into the range. So what does this tell us? Well, if we've established that there is a lot of liquidity above this high, this means that someone that has a very large force in the market is selling, because if there is liquidity available at a certain level and you see the market move away from it, that tells you that the market is responding very aggressively from this level and somebody is utilizing all that liquidity, because all these people who are buying the market here because they're getting stopped out on their shorts, or some traders are buying the breakout, well, some larger force is selling to them. Now, this is really the entire foundation of ICT, and everything else, all the other complicated concepts, it all comes back to this. So if you can simplify it into a mechanical and repeatable process, then you will become a more successful trader. Once the market hits into this high, if you notice, we get what? One of the two confirmations we spoke of. Now we see a displacement. The market comes through and it pushes through these candle bodies. So this is a change in the state of delivery, because we had this up move right here, and you can see that the market was in control on the buyer side. So the buyers were engulfing the down close candles here and here and here until we hit that level, which was the first 30-minute high, and the market came down and it closed below it. So we have a displacement back into the range. Now, you could also use a fair value gap. If the market creates a fair value gap back into the range, that also qualifies for an entry. But for the first candle rule, once the market hits into that 30-minute high and you get a displacement back into the range, you're going to enter a trade with your stops at the candle bodies, and you're just going to target a fixed 2-to-1 risk to reward. Yes, it is that simple. So to recap, you wait for the high or low to get hit, and then you wait for a change in the state of delivery or a fair value gap back into the range. And at that time, you would execute the trade and then sit back and know that you have a very high probability setup. You just target 2-to-1, which means that you're going to make twice as much as you risk if the trade hits, and then you do literally nothing. You just let the trade play out. And as you can see, this trade played out very quickly. Now, I've showed you two very easy ways to trade, and these were both on the same day, and it goes to show that ICT does not have to be hard. And in fact, you just needed the right system, and it can be very, very easy. Now, if you want to trade with me at Market Open, have every trade that you take reviewed, and be directly mentored by me, I'm going to leave a link down in the description where you can apply to join my mentorship. Now, not everyone is going to qualify, but if you do, I guarantee that you will become a funded trader in 12 weeks, or I will personally trade with you until you get funded. That is how confident I am in the system that I teach. You now have everything that you need in order to make ICT easy. We talked about liquidity. We talked about fair value gaps. We talked about the time-based liquidity strategy, where you just wait for one of the session or previous day's highs or lows to get hit and then look for a confirmation. And we talked about the first candle rule, which is quite literally one of the simplest strategies that you will ever find. And that's all for this one, guys. So make sure to subscribe, and I'll see you in the next video.